What is audit? Audit is an independent examination of financial information of an entity, whether profit oriented or not, irrespective of its size or legal form, when such examination is conducted with a view to express an opinion thereon. Its relevant essay is 200, which states overall objective of an independent auditor and the conduct of an audit in accordance with standards of audit. Overall objective of an auditor are first to obtain reasonable assurance whether financial statements as a whole are free from material misstatements. Second, whether financial statements are prepared in all material aspects in accordance with applicable FRF financial reporting framework. Third, to report on financial statements and communicate as required by SA in accordance with auditor finding. Scope of audit. It is always determined by term of audit engagement, requirement of relevant statute, and ICI pronouncement. Term of audit engagement cannot supersede the requirement of statute and ICI pronouncement. Advantages of audit of financial statement. First, it safeguards the financial interests of the persons not associated with management, that are stakeholders. Second, it helps in moral check of the employees from committing embezzlement or defalcation. Third, it helps in setting taxabilities, negotiating loans, and diminution of persons' consideration of the business. Fourth, it is useful in trade disputes for bonus and wages. Fifth, helps in detection of wastage and loss due to inadequate internal control. Sixth, review the existence of internal control and report the inadequacy or weakness. Seventh, helps in settlement of accounts at the time of admission or death of the partner. Eighth, government may require audited financial statements before giving subsidy or license, etc. Inherent limitations. Inherent limitations are those limitations which are involved and can't be avoided. Audit risk can never be zero. Auditor never give absolute assurance that financial statements are free from material misstatement due to fraud or error due to inherent limitation. Other limitations in an audit are: first, nature of financial reporting. Preparation of financial statements involve judgment, subjective decisions, or degree of uncertainty and are based on interpretation made by management. Second, nature of audit procedure. There are practical and legal limitations on the auditor liability to obtain evidence, like management not providing complete information as required either intentionally or unintentionally, and auditor is not an official investigator having legal power to investigate and search, etc. Third, timeliness of financial reporting and balance between benefit and cost. Relevance of information in value tends to diminish over time, and auditor have to strike a balance between qualities of an auditor. Auditor must be honest and must not certify what he believes does not to be true, and must take reasonable care and skill before he certifies what he believes to be true. Second, have exhaustive knowledge of accounting. Third, intensive program of theoretical education. Fourth, thorough knowledge of principle of law, especially company law and law relating to contract. Fifth, highest degree of integrity backed by adequate independence. Best qualities according to Dixie: judgment, integrity, caution, and knowledge of industry. Seventh, knowledge of client business. Eighth, thoroughly know all accounting principles and techniques. SQC1 deals with firm responsibility for quality control and includes policies and procedures addressing elements like leadership responsibility for quality within firm, ethical requirement, human resource, audit performance, monitoring, and acceptance or continuance of audit, client relationship, and specific audit engagement. SA 220 deals with quality control of an audit within firm. So, engagement partner shall emphasis on performance, quality, audit report, raise concern without fear, and explain importance of quality. Acceptance and continuance of client relationship and specific audit engagement. SQC1 requires firm to obtain information before accepting the engagement so that decisions regarding audit engagement shall be appropriate. It includes integrity of owners, key management, TCWG, and capabilities of audit engagement and adherence of ethical requirement and impact of previous audit. Independence of auditor. Auditor should be straightforward, honest, and sincere in his work. He must be fair and must not allow prejudice or bias to override his objectivity. He should maintain impartial attitude. Independence is a condition of state of mind as well as personal character. Safeguard to independence. Auditor must be independent to have confidence in public. Always follow fundamental principles: integrity, objectivity, and professional skepticism. Before accepting any work, consider whether any threat to independence exists. If threat exists, then try to eliminate it. If not, then desist the task. If auditor is unable to implement credible and adequate safeguard, then must not accept the work. Independence of auditor is not only exist in fact but also to appear to exist to all reasonable persons. Threats to independence. First, self-interest threats. Benefits from the financial interest in an audit client. Second, self-review threats, where an auditor have recently been a director of the company, or where auditors themselves provide services which are subject matter of audit. Third, advocacy threat, which occur where the auditor promotes or is perceived to promote a client opinion to a point where the people believe that auditor objectivity is compromised. Fourth, familiarity threat, where the auditor forms relationship with the client, where they end up being too sympathetic to client interests, and it involves formal partner, close relative, gifts, and long association. Fifth, intimidation threat, threat of being replacement over the disagreement of accounting principle application. It involves threat of replacement and pressure to disappropriately reduce audit fees. Revision of audit engagement required when misunderstanding of scope and objective of audit. Revision of special terms of audit engagement. Change in senior management. Change in ownership. Significant change in nature and size of entity business. Change in legal or regulatory requirement. Change in FRF adopted in preparation of financial statements. And change in other reporting requirements.